Hello, everybody. Welcome back to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gay, joined as always by Zachary Green, and we are wrapping up another really eventful week in the markets. Zach, it feels like every single day lately, investors are dealing with a new headline.
Yeah, it definitely does. Inflation, treasury yields, oil prices, Nvidia earnings, Fed expectations. It's been a lot all at once.
It really has. And honestly, that's kind of the environment we're in right now. Markets are trying to balance incredible corporate earnings and AI momentum against higher interest rates, inflation concerns, and geopolitical uncertainty. So today, we're going to break all of that down in plain English and talk about what actually matters for everyday investors. And we have 5 lovely segments organized for you today.
Yeah, and it's definitely been another volatile week, so this should be a good one.
Absolutely. So let's start there with the markets. So segment 1, the markets. So after hitting fresh all-time highs earlier this month, markets have cooled off a little this week. The S&P 500 is still hovering around 7,400, the NASDAQ around 26,000, and the Dow around 50,000, which are still historically elevated levels.
Yeah, and honestly, if you zoom the graph out a little bit, the performance this year has still been really strong.
Very strong. Even with this week's pullback, the S&P 500 is still up around 8% year to date, while the NASDAQ has gained over 13% in 2026, thanks largely to tech and AI-related stocks continuing to lead the way.
Yep, but investors are definitely getting more nervous about interest rates again.
That's right. That's the big story underneath the surface right now. Treasury yields have surged higher over the last couple of weeks. The 10-year U.S. Treasury, which is a benchmark interest rate out there, briefly pushed towards 4.7%, and the 30-year Treasury moved above 5%. These are levels we haven't consistently seen in years.
Yeah, for the people that may not follow the bond market as closely, higher treasury yields usually creates more pressure on the stock market.
That's exactly right. Higher yields mean borrowing costs become more expensive throughout the economy. Mortgages, car loans, business borrowing, credit cards, all of it. And from an investing perspective, which is when safer government bonds start yielding 5%, investors naturally begin comparing that to stock market risk.
And that's a part of why we've seen these big swings lately.
Right. We've had multiple 1% daily market moves recently. Some days the market rallies hard on earnings optimism, and then the next day inflation fears or rising oil prices hit sentiment again. That's what volatility looks like in real time. Segment 2, inflation and oil. Inflation remains one of the biggest concerns right now. Recent inflation data came in hotter than expected, and energy prices are playing a major role in that.
Yeah, and oil prices have stayed elevated because of the Iran conflict and Middle East tensions right now.
Exactly. Oil recently traded above $100 a barrel again. And when energy prices rise, it tends to ripple through the entire economy. Transportation costs go up, airline tickets rise, shipping costs increase, consumers feel it everywhere.
And that's really what changed the conversation around rate cuts this year.
It did completely. Earlier this year, markets were pricing in multiple Fed rate cuts for 2026. Now investors are questioning whether we are even going to get one rate cut this year. Some traders are even discussing the possibility of another rate hike if inflation stays sticky.
That's a huge shift for rate expectations.
Yeah, in just over a few months, huge shift. And it shows just how quickly market narratives can shift and change. Segment 3, the Fed and interest rates. The Federal Reserve is really in a difficult position right now. This is nothing new. We've talked about this on the show multiple times. Economic growth has held up better than many have expected. The labor market's still relatively healthy, but inflation is proving stubborn and sticky.
Yeah, so that's really why the Fed can't justify cutting rates aggressively right now.
Right, exactly. The Fed keeps saying they need more confidence inflation is moving sustainably lower before easing policy. And right now, the bond market's basically forcing everybody to pay attention to that message. One stat that really stands out is a 30-year Treasury yield recently touched its highest level since 2007, going above 5%. That's before the financial crisis, so some 10 years ago.
Yeah, and considering 2 years ago, we were thinking that number was going to be going down pretty steadily. That's kind of an eye-opener.
It really is. And it matters because higher long-term borrowing rates eventually tighten financial conditions across the entire economy. Housing slows, borrowing slows in general, and consumers become more cautious. All right, moving right along. Segment 4, earnings and AI. Now, despite all those concerns, corporate earnings continue to come in surprisingly strong.
Yeah, especially in the tech sectors.
Yeah, especially in tech and AI related companies. Nvidia reported another huge quarter this week. I think Wednesday they reported, and continued reinforcing the idea that AI spending remains one of the strongest themes in the market right now. And overall, first quarter earnings season has been excellent. We've talked about this on here before. The S&P 500 earnings growth is tracking above 25% year over year, which is far stronger than analysts expected just a few months ago.
Which helps explain a lot about why the stocks have stayed relatively resilient even with all this volatility.
That's right, Zach. Markets are basically wrestling between two competing forces right now. On one side, you've got strong earnings, AI optimism, and economic resilience. But on the other side, you've got inflation pressure, higher treasury yields, and uncertainty around Fed policy.
Yeah, so you kind of have the bond market and the stock market playing a little tug of war right now.
That's exactly what it feels like. Segment 5, our final segment for today, what investors should keep in mind going forward. And I think that this is where perspective really matters, because when volatility picks up, investors naturally start feeling anxious. But it's important to remember that volatility itself is not unusual for financial markets.
Yeah, especially after a big rally like the ones we've had.
Yeah, exactly. I think we're coming off 7 this week. We closed positive today. This will be 7 winning weeks in a row, I think, for the S&P 500. So the S&P 500 has had an incredible run over the last year and a half. Pullbacks, consolidation, and volatility are normal parts of investing. They don't automatically mean something is broken. At the same time, this is probably not the type of environment where investors can just blindly chase momentum either. Higher interest rates do matter, valuations matter, and risk management matters as well.
Yeah, and I'm probably going to sound like a broken record here, but this is exactly why staying disciplined and diversified is still so important.
It is. And patience, right? Absolutely. Long-term investing usually rewards patience more than prediction. So in closing, let's wrap up with the Main Street summary for the week. So markets remain near historically high levels, but volatility has picked up as Treasury yields surge and investors reassess interest rate expectations. The S&P 500 is still up around 8% year to date, while the NASDAQ continues outperforming thanks to AI-driven momentum. Treasury yields have climbed to some of the highest levels we've seen since before the financial crisis, creating pressure on stocks and interest rate-sensitive areas of the economy. Inflation remains sticky, largely driven by energy prices and oil market, services sector inflation, while the Fed continues signaling patience on rate cuts. At the same time, corporate earnings, especially in technology and AI-related stocks, continue coming in strong and supporting the broader market.
And I think my big takeaway this week is uncertainty is elevated, rates are elevated, but strong businesses and long-term investing principles are still king.
And they don't go anywhere. Those don't change over time. The market dynamics change, but the solid financial advice usually doesn't change over time. So stay disciplined, stay diversified, and don't let short-term headlines completely drive your long-term financial decisions.
Yeah, definitely. And thank y'all for joining us this week.
Yeah, thank you guys for tuning in. Don't forget, interact with us, share our content, helps other people find the show. We're on Facebook, LinkedIn, and YouTube. Have a great rest of your week, holiday weekend, and we'll catch you back here next week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.